Okay. So students, good morning. Welcome to today's IM session. So in the previous class, so we were discussing about the macroeconomic and industry analysis. Can anyone tell me, can you see the slide?
Yes,
Yes,
sir.
sir.
Okay, perfect. So we are understood now the difference between the fundamental analysis as well as the technical analysis. When it comes to long-term investment, the investors will primarily go for fundamental analysis. Whereas when it comes to short-term investment or short-term trading, let it be intraday or swing trading or holding it or selling it within a year. So normally, the traders will go for technical analysis. So let me just show you what is today's market, and then we will continue with the session. Please see the screen, students. Today we will just have a glance of the market, today's market, then immediately we'll go to the session. So I will be opening the websites of BSE and NSE, the official website. So today, if you can see here, BSE, Bombay Stock Exchange Sensitivity Index, the value is 40,485.91. And today it is up by 224.78. So who are the top gainers in BSE Sensex? If you come down, you can see here. You can see market capitalization. See, 35% that is positive, 183 stocks are there, and negative we have 158 stocks. That means their positive means what? When compared to yesterday's closing, today they have opened positive. When compared to yesterday's closing, today they have opened negative. It is down. Okay. Now similarly, we will see the NSE's website, that is National Stock Exchange, which consists of top 50 stocks in terms of market capitalization. You can see here it is 11,873.80. It is up by 60.30. Okay. See, students, here if you can see the graph here, pre-open Nifty it has taken a rally here, and it has reached this level, and it has come down, and again it has beaten this level. It has again come down, and now you can see here there is a drastic green line here, which indicates that there is an uptrend every time it is touching the new lows. Okay. You can see that yesterday I had sent you one thing, that is Sun Pharma. Today you can see Sun Pharma, it is 503. Why? Can anyone tell me? Why Sun Pharma share today it is up by 20 rupee? Can anyone tell me why today Sun Pharma is up? Yesterday I had sent in the group the reason for this. See here, almost 17 rupee 55 paise. Even if it is wrong, you tell me why today this particular stock as expected has gone up. See, the opening was 499.90, and presently the last traded price, that is LTP, is 503.15. Yesterday I had sent in the group that Sun Pharma Q2 results, net profit has jumped by 70%. Correct? See, Sun Pharma's quarterly profit rose on the back of lower operating expenses and higher other income. Correct? So net profit rose 70% year on year to rupees 1,813 crore in the 3 months ended September. That is India's largest drug maker is Sun Pharma, correct? Which is a listed company. So, revenue rose by 5% over a year earlier to rupees 8,553 crore, compared with the estimated was 8,302 crore, 8302, whereas it has it has beaten the expectation. So Sun Pharma's operating profit rose by 30% to rupees 2,310 crore against the forecasted operating profit of 1,861 crore. And the margin also improved to 27% over the year earlier when compared to 22%. Correct? So it was expected that today the Sun Pharma will go up. So what I did actually, I just reviewed the Q2 results of this particular company. Can anyone tell me Sun Pharma belongs to which sector? Sabia, Sun Pharma belongs to which sector? Preetham is messaging pharma. Correct. It belongs to pharma sector, right? So you being a long-term investor, I'm telling to all of you, you should be thoroughly understanding the sector to which it belongs to. Suppose if you are taking a company, so you need to understand the sector to which it belongs to. Okay, you need to study the financial performance of the company, that is quarter by quarter, right? So this was about the today's stock market analysis. So you can see here the some of the gainers and some of the losers also. See, Axis Bank, ICICI Bank, Hindalco, and Power Grid. These are some of the losers. Okay. Now we will come to the theories of technical analysis, which we were about to start from today's class. Students, last time I'm asking, am I audible to everyone? Can anyone say yes, sir, so that I can start? Can anyone?
Yes, sir.
Yes, sir.
Yes, sir.
Okay, perfect.
Sir,
Okay.
you're audible.
Okay. Now you all know that is technical analysis. Purely we use charts to predict the price of the movement of the particular stock. Now remember students, when it comes to stock market, there are two type of animals which we actually use for buying as well as selling. These are the animals are called as bulls and bears. Remember this. See, bulls means what? Aggressive, right? So what then? How do they attack bulls? They actually use their horns and they lift it. They lift a human being in the upward movement, right? So in the similar way, when more number of buyers are there in the market, we say that the market is very bullish. Correct? And bears, how do they attack? They try to put you down, right? They try to put you down. They slap you. They try to put you down. That is how they attack. So when more number of bears are there in the market, we say that the market is very bearish. So it is basically a fight between the buyers and the sellers for a common price. So when more number of when the demand for a particular company increases, more bulls will come into the market. When the demand for a particular script decreases, the bears will come to the market. Now, you can, 1 minute, I'll show you the bulls and bears also here. When it comes to the book value, you can see the bulls and bears also here. I'll show you that. Now today, you can see here, Axis Bank is concerned, it is 521.55, right? It is down by 12.60. So why it is down? Because there are more number of selling pressure in the market. You can see here, students, please see here order book. This we call it as order book. This is a one indicator. I'm repeating my words. This is one indicator which tells me how many buyers are there, how many sellers are there. Students, you can see to where my cursor is there. This is the buying. These are bulls and these are bears, the selling order. Okay. See, there are total quantity 6,64,388. Buyers are there. Whereas see the selling pressure here, more number of bears are there, right? That is 10,87,850. Right. So for example, we will take this stock where more number of bulls are there. We will take Sun Pharma. So in Sun Pharma, what happens? More number of bulls are there because it is going up, and more and the number of bears are less. So we can just check here in the order book. You can see here all of you 15,51,234 buyers are there. Buying bulls are there. Total quantity. You can see my cursor. Whereas here you can see the sellers are 10,70,798. So this is one indicator. We call it as, what do we call this as? Market depth. That is order book. Please remember this order book. So once you go to the broker, you can ask him, okay, put me the order book of a particular company. So in the similar way, I will show you now for ICICI Bank. In ICICI Bank, what happens? ICICI Bank, let me see. ICICI Bank is down by 8 rupees 60 paise. So if I want to know whether more bulls and bears are there, I go for the order book and just see here. See here what has happened. 10,81,757 orders are there for buying. That means bulls are there. Whereas 14,18,497 sellers are there. That means the selling pressure is more, right? So for all the scripts, you can just check here. Similarly for Britannia. Britannia, what is? Britannia, we will see the current market price. Per share, it is 3,490.60. Students, it is today up by 86 rupee 95 paise, right? But when I go to the order book, what I understood here, you see the buying quantity as well as the selling quantity here. That is the buyers and the sellers, or the bulls and the bears. You can see 94,614 quantity, total quantity of buyers or the shares which they have put for the buying order, as well as 79,317. That means more buying pressure is there for this particular script, right? So this is one indication for me that based on the bulls and bears, I can say that this particular script has got more buying pressure, or this particular script has got more selling pressure, right? So this we call it as order book. Clear, students? Order book. So you came to know now that if more number of buyers are there for a particular script or in the market, then automatically the price will go up. And if more number of sellers are there, automatically the price will come down. So it's a tough fight which happens between a bull and a bear, or a bulls and a bears. Okay. Now after understanding the basic thing, now we'll understand few theories of technical analysis. The first theory is called Dow theory, and the second one is called Elliott wave theory. Now we will try to understand what is this Dow theory. Okay. See, the Dow theory on the stock price movement is a form of technical analysis that includes some aspects of sector rotation. See, Charles Dow formulated a hypothesis that the stock market does not move on a random basis, but it is influenced by three distinct cyclical trends that guide its direction. So bull markets, as you all know, are markets where the market is going up aggressively over a period of time. As the market starts to rise, there becomes more and more greed in the stock market. Whereas the bear market definition is exactly the opposite of the bull market, which just now I explained all of you. It's a market where quarter after quarter and the market is moving down about 20%. That signals a bear market. And when that happens, people start to get really scared about putting money into the stock market, correct? So now we'll try to understand the basic tenets and premises of Dow theory. So the first tenets and premises of Dow theory will be, Average discounts everything. The first one is average discounts everything. Then what do you understand by that? That means the aggregate judgment of all the stock market participants regarding both the current and the potential changes in the demand supply relationships of the stocks is reflected in the share prices. In other words, the share prices that are determined in the market evolve out of a discounting process. So that takes all known and predictable factors into account. The second one will be market has three movements. Please understand which are the three movements, students, as per the Dow theory. The first one is called primary movement. The second one is called secondary reactions or secondary movement. And the third one will be minor movements. Now we'll try to understand what are these primary movements. See, primary movements which last from about a year to several years represent the major market trends. It can be either bull trend, that is a rising trend, or a bear trend, that is a falling trend. See, a primary bear market trend can be seen as a long decline interrupted by some rallies. Let me show you what is this primary bear market over the graph. When I take you here, in 2007 to 9, there was a fall in the market, right? So years together, there was a decline. If I go for the max. Okay. See here, students, all of you. See, this was the time you can see, since inception of the market from 1990, it has always, it is moving in the upward direction. Okay, upward trend is there. But what happened in 2007? All of you know that, right? There was a sudden, news regarding there was a lot of scandal which came up. That is a subprime mortgage crisis, as well as the Lehman Brothers. Right. So that was a financial crisis which happened between 2007 and 8. So what happened, students? Here, 2007, the market started falling. Complete year. That was, it went to this level in 18 January 2008. That was around 19,013 Sensex was. Then it came down. It came to 11th. Almost, wait. I'll show you the bottom now. Yeah, 8,000 level. Even touched about 8,325.82. That was on 6th March 2009. See, almost from when it dropped, that is 2007, 2008, and 2009. Correct? So what I mean to say is a primary movement. We are observing a primary movement. So primary movement means what? Which lasts from about a year to several years. Represent the major market trends. It can be either rising, that is a bull trend, or a falling, that is a bear trend. So what we are seeing here from 2007 to 2009, it was a major falling trend, right? So a primary bear market trend increase in price that occurs after a falling trend in, a primary bear market trend can be seen as long a decline interrupted by some rallies. But you need to understand, students, here that 2007 and 8, it was called as a financial crisis. The entire global financial crisis happened. It was a severe worldwide financial crisis. That was excessive risk taking by banks combined with the bursting of the United States housing bubble caused the values of securities tied to US real estate. Correct? Damaging financial institutions globally. So some of the huge financial companies like Lehman Brothers, they announced bankruptcy. That was on 2008. That was an international banking crisis, okay, which led to the major decline in the stock market. So here, during this, global factor, our Indian market also deeply, the bears came into the market, due to which it came down, okay. And then after that, what happened, students? It was also followed by the European debt crisis, which began with the deficit in Greece in late 2009 also. See, almost you can see here from 2007 to 2009, you can see the bottom year, that is 8,325 Sensex. But see, students, imagine here, if someone would have put their money at this level also, that is at 8,325, how fast it recovered, you can see here. See, very, very interesting thing I want to show you. 6th March 2009, it came to 8,325, then it started recovering in the same year. The Sensex went to 15,411. See, then what happened here? Somewhere in between, again the market fell down because of the European debt crisis, which began with a deficit in Greece in late 2009. Okay, so what I mean to say you is these global factors also have a direct impact on the equity market movement. Okay, see, over a period, if you can see the graph, it is always an uptrend. Okay, and this was the time when that the corona. See, the market started falling here. It came to the bottom, students. That is, you can see here that 27,590.95. That was on 3rd April 2020. If we would have entered the market at this point also, today you can see it is almost at 40,441.57. So just imagine here how many months it has taken to recover, students. April, May, June, July, August. Almost 3-4 months the market recovered, right? So see, what normally people say is every dip in the market or every fall in the market, the bulls will be entering into the market, or every fall in the market will be an opportunity for people to invest in the market. Okay, I wanted to show you one more thing. This, see this, students. Today morning only I had put this message, right? See, Root Mobile. See here.
Sir, sorry to disturb you, but sir, your skin is not visible, sir. And your voice is breaking too, sir.
See, that was on September, that is 21st September, it was 651.3 Indian rupee, right? Now what happened? 651, if you would have purchased, it went to this level, students. 1096. 1096. Right?
Hello, sir.
So we call them as multi-baggers. That means they give fantastic returns. Okay. So what I was explaining you, basically the basic tenets and the premises of Dow theory. Okay. So primary movements, all of you understood, right? A primary bear market trend can be seen as a long decline, interrupted by some rallies. Now, what do you mean by a rally? A rally is an increase in price that occurs after a falling trend in prices. It is important that though few rallies have occurred, the long-term trend in prices is bearish. A primary bull market trend is a broad upward movement interrupted by some reversals. Now, you need to understand a reversal. A reversal is a decrease in price that occurs after a rise in prices. So primary trends, what do you mean by primary trends? Primary trends are thus long-term movements in prices interrupted by swings in the opposite direction. Okay. Now we will understand the secondary reaction. A secondary or an intermediate reaction is defined as an important decline in a bull market or advance in a bear market. It's an exactly opposite, students, lasting from 3 weeks to as many months. So during this interval, the movement generally retraces from 33 to 60%, 66% of the primary price change. Sometimes a secondary reaction almost wholly retraces the primary trend, where the reaction is more than 50%. Then last but not the least is minor movements. See, movements in prices daily that form only intra-daily are called minor movements. That is for a day. These movements will be for a day. Primary movements means it will be for a year or more than that. Secondary reactions means it will be almost for a few months, and minor movements will be in terms of daily. Okay, so movements in prices Daily that form only intra-daily are called minor movements. They have no implication for long-term forecasting, though short-term investors tend to manipulate them to some extent. Okay. And last will be price action determines the trend. A trend can be called primarily bullish when successive rallies lead to peaks that are higher than the preceding ones, and when troughs reached by the intervening secondary reactions are above the preceding troughs. Similarly, a bearish trend is marked by a series of descending peaks and troughs. A reversal in primary trend is indicated when the above tenet does not hold. Now, we will study the Elliott wave theory. See, according to the Elliott wave theory, the market is unfolded through the basis rhythm or pattern of 5 waves up and 3 waves down to form a complete cycle of 8 waves. This wave principle is derived from the empirically tested rules from the studies on the stock market price trends. The basic pattern of waves is reflected in various cycles and waves. One complete cycle consists of waves made up of two distinct phases, that is bullish as well as bearish. Clear? So what happens here in Elliott wave theory, as the name only suggests, there will be almost 5 waves. Wave means what? About half of the first wave are a part of the basing process and often appearing to be nothing more than a rebound from very depressed levels. 1 minute, let me show you. Okay, all of you can see the graph, right? So you can see the waves over there, students. About half of the first waves, you can see here, wave 1, wave 2, okay, are a part of the
Excuse,
basing process and often appear to be nothing more than a rebound from very depressed levels. First waves are usually the
hello,
shortest
sir.
of the 5 waves. Correct? You can see the diagram over there. These first waves can sometimes be dynamic, especially if they occur from major base formation. Then wave
Excuse me,
2 is
sir.
concerned. You can see this. First wave, you can see this. See my mouse cursor, students. Second wave, you can see here, this one, or a vice versa. Second waves usually
Excuse me,
retrace or
sir.
give back all of the most of wave 1. The ability of wave 2, however, to hold above the bottom of wave 1 is what it produces many of the traditional chart patterns, such as a double or a triple bottom and inverse head and shoulder bottom. Then we have the third wave. The third wave is usually the
Excuse me,
longest.
sir. Excuse me, sir.
Please, I'll repeat once again. The third wave is usually the longest and the most dynamic, at least in the common stock area. The penetration of the top of wave 1 registers all kinds of traditional breakouts and Dow theory buy signals. Virtually all technical trend following systems have jumped on the bull bandwagon by this point. Volume is usually the heaviest during this wave and gaps prevail. Then wave 4. The fourth wave is usually a complex pattern like wave 2. It is a corrective or a consolidation phase, but usually differs from wave 2 in its construction. So triangles usually occur in the fourth wave. One cardinal rule of Elliott analysis is that bottom of wave 4 can never overlap the top of wave 1. Please, I'll repeat once again, students.
Excuse me, sir.
Elliott analysis will tell that the bottom of wave 4 can never overlap the top of wave 1. Okay? Then last but not the least, that is the fifth wave is concerned.
Hello, sir.
The fifth wave is concerned.
Excuse me, sir.
Wave 5 is usually much less dynamic than wave 3. So wave 5 is often the longest wave and the one most likely to extend. It is during wave 5 that many of the conforming technical indicators such as OBV, that is on balance volume, begin to lag behind the price action. It is also at this point that negative divergence begin to develop on various oscillators. Thus, what I want to conclude here, students, when it comes to Elliott wave theory, the wave 1 is upward
Excuse
and
me,
wave
sir.
2 corrects the wave 1.
Sir.
Similarly, wave 3 and 5 are those with an upward impulse but are corrected by wave 4 and other waves respectively. And according to the Elliott wave theory, accuracy and timeliness of the waves is the basis for their usefulness in identifying the buy and the sell signals in the market. And also, students, it has been found that the behavior of the prices on the stock market conforms to the cycles and waves, and it is possible to use these data for predicting the price change and declining on the buy as well as on the sell signals.
Excuse me, sir. Hello.
One minute, I'll drink water. Okay. Next, we'll try to understand the charts. This is a very important part in the analysis, that is technical analysis. Now, these charts, they provide the visual assistance in detecting the emerging and the changing patterns of price behavior. See, even charts represent a key activity in technical analysis because graphical representation is the very basis of technical analysis. It is the security prices that are charted. And one more thing, students, the chart is the basic tool used by the technical analyst to study the share price movement or even to predict. See, everything I'm telling you is we can only predict the price movement. So charts provide visual assistance in detecting the emerging and the changing patterns of the price behavior. So in charts, first, let me show you the line chart. See, what happens in case of a line chart is, 1 minute. See, a line chart is a graph. Okay, okay. A line chart is a graph of successive days closing prices. I'll repeat once again. A line chart is a graph of successive days closing prices, and it is created by connecting a series of data points together with the line. So this is the most basic type of chart used in finance. And it is generally created by connecting a series of past prices together with the line. So what they do, they keep on, drawing the line. So how do they connect the data points over there? The day's closing prices will be connected. Every day's closing prices will be connected, and based on that, the line chart will be plotted. Okay. And we even say that line chart will be the most simplest and the easiest way to plot a graph because we use only one parameter here, that is the closing prices. And it is also created by connecting a series of data points together with just a line, correct? So this is the most basic type of chart used in the technical analysis, and it is generally created by connecting a series of past prices together with the line. So the next type of chart, what I'll be explaining you now is the bar chart. So what happens in case of bar chart, students? Let me explain you first, then I'll show you the graph. See, in case of bar chart, they have a series of vertical bars representing each day's price movement. I'll repeat once again. Bar charts have a series of vertical bars representing each day's price movement. Each bar has a range from the day's lowest price to the day's highest price. A small cross on each bar signifies the day's closing price. The bars can be, let me show you, and parallelly I'll explain you so that you can see both of them. Let me close all these windows. With the help of the chart itself, let me explain you so that you can understand. Okay? Yeah. This would be better actually. Yeah. Okay. See, a bar chart have a series of vertical bars, which you can see in the diagram over there, representing each day's price movement. So each bar has a range from the day's lowest price to the day's highest price. A small cross on each bar signifies the day's closing price. Students, you can see here, there is a small cross, right? A small cross on each bar. See, on each bar, there is a small cross on each bar, which signifies the day's closing price. The bars can be horizontally oriented, also called bar chart, or vertically oriented, also called column chart. So sometimes a stretched graphic is used instead of a solid bar. What you are seeing now presently. It is a visual display used to compare the amount or the frequency of occurrence of different characteristics of data. Okay, and it is used to compare the groups of data. Okay, so this is about your bar chart. The next type is called as a very important one, that is called as Japanese candlesticks, which normally it is one of the most popular candlestick pattern or the chart pattern used presently by almost all the technical analysts. And see, students, one more point I want to tell. There is no standard method of predicting the stock price movement. It all depends on an individual. For someone, Japanese candlesticks they'll be using, some people they'll be using still more simpler one. So whichever you feel better, you can. Student, can you see the screen?
Yes, sir.
Hello, sir.
But someone has messaged, hello sir, we can't see the screen.
Yes, sir. Yes, sir. Before that, we
Okay.
could not able to see the screen, sir. Now it's visible.
Okay.
I see the
Sorry,
text.
extremely sorry for that. See, in between, if you have something like this, you can speak and interrupt me and tell me that sir, the screen is not visible. Okay, instead of messaging me, directly tell me that the screen is not visible.
Yes, sir. We are trying to tell you, but you can't able to hear us.
Okay. Sorry, extremely sorry. Now you can see. Can anyone tell me yes, sir?
Yes, sir. Now it's visible.
Oh, okay.
Yes,
Perfect.
sir. The types of charts.
Perfect.
Yes, sir.
Perfect. No, not type of charts. This bar chart diagram is visible.
No, sir. Now it's types of charts.
No,
only.
sir.
Slide is visible, sir.
Okay. Okay. So in case of bar chart, they have a series of vertical bars representing each day's price movement. So each bar has a range from the day's lowest price to the day's highest price. A small cross on each bar signifies the day's closing price. The bars can be horizontally oriented, also called bar chart, or vertically oriented, also called the column chart. Next, a very important charts which are used by majority of the technical analysts worldwide is called Japanese candlestick. See, why the name Japanese candlestick is very interesting here. See, Japanese candlestick developed in Japan more than 300 years ago. So candle charts were popularized in Western countries through, one of the author, that is Steve Nison's book. Then Japanese candlestick charting technique. It shows the open, high, low, and the close prices. So a candlestick chart is a Japanese candle is a style of financial chart used to describe the price movements of a security. Each candlestick typically shows one day. Thus, a 1 month chart may show the 20 trading days as 20 sticks. So let me show you the Japanese candlesticks now, so that you will understand how exactly it will look. Let me try to show you now. Students, you can see NSE screen? Or you still not able to see? NSE screen you can see?
Yes, sir. Yes, sir.
Yes, sir.
Okay, perfect. I came to know.
Yes, sir.
Perfect. So Japanese candlesticks, let me show you with the diagram and explain. Okay. Now, in case of this Japanese candlesticks, you can see over there are two types. You can see, right? Is it, you can see it is visible?
Yes, sir.
Okay, perfect then. Now, candle charts, they usually display the prices. So candle in the right, what you are seeing, where my cursor is there, students, you can see here, candle in the right part is a long white. The white real body, this is called as the body, shows that the securities close is higher than its open. That means it's a bullish tone. Okay, so here these are called tails. This is the high price, this is the closing price, and this was the opening, and this was the low. And similarly here, opening price and the day's high, and the closing price and the low price. Now, the shadow, see, these are called as the lower shadow. This one, the lower shadow, these are called as lower shadow, and these are called as upper shadow, right? And these are called as a real body of a Japanese candlestick. So the shadows display the prices above and below the open close range. This range is relatively large. Therefore, the body is long. The candle in the right is a long black line. The black real body shows that the close price is lower than that of the open. Right? See what happens here in case of Japanese candlesticks. I'll repeat once again. These two are, it is called as a real body. That means, see, in the real body, you can see the range between the opening as well as the closing. You can see here, right? Opening and closing. Opening and closing. Okay. Then you have these are upper shadow. These two are upper shadow, and these two are lower shadow in case of a candlestick. But in candlestick, students, they show see how many parameters we can see in using these Japanese candlesticks. We can see the open, high, low, and close of the prices of a security. Correct? So this gives us the perfect data when it comes to prediction of the next level of the price movement of a particular stock. A candlestick chart is a style of bar chart used primarily to describe the price movement of a security. It is a combination. Which one? The Japanese candlestick, students, it is a combination of a line chart and a bar chart. In that, each bar represents the range of the price movement over a given time interval. It is most often used in technical analysis of equity and other like currency, commodity, and all. See, you don't believe, right? Some of my own students, they use this Japanese candlestick pattern. They try to predict the price movement. I'm using the word predict. I cannot exactly tell you what could be the price movement in the next minute. Okay, I can just predict based on the historical prices that the price might go up or it can come down, or this is your support level, or this is the resistance level, or should I hold particular stock. So on a day, with minimum investment, you can make up to 2.5 to 3,000 rupee with minimum risk. And I have seen some of the students who are making 2.5 to 3,000 in a day using minimum investment. But this cannot be mastered at an early phase. I'm using the word. It cannot be mastered. It takes years together of reading what, understanding the patterns, understanding the the signals, understanding the waves. So then only you can easily predict the price movement. But in spite of that, I am using the word, even the experts who are there from past decade in the share market or in the equity market, they can predict the price movement. Clear? It cannot give an absolute picture of to anybody that the price will move in the upward trend or in the downward trend. Why? The reason I'll tell you. Suppose if someone has told me the buy signal, okay, and suddenly some global factor has come, global factor which will have a direct influence on the equity market. So the global factor is not in favor of the Indian equity market. Then even though the technical analyst has given the buy signal, that stock price tries to move in the opposite direction. So what I suggest all of you when I'm delivering this particular lecture is, technical analysis helps to predict the price movement. Plus, apart from that, you should be even parallelly studying the factors, the everyday factors, which will have an impact on the Indian equity market. Otherwise, what happens is your chart will be telling buy, but the markets will be going in the opposite direction. Okay, so you should be very, very cautious. You should be parallelly watching the news channel. You should be parallelly getting the information about a particular stock. Suppose, see, remember the Sun Pharma. Yesterday the news came that the profits of the company have beaten the expectations. So obviously, the more and more bulls will come in the market. But if someone had predicted, based on the technical analysis, based on the historical prices, that the price might drop today, then what would have happened? Tell me. He would have given a sell signal, but the stock price would have moved in the upward direction, right? So your complete analysis would be a failure. So in order to understand, in order to give a proper signal, so you should understand both the fundamental factors or the global factors or the macro factors or the micro factors as well as the technical analysis. Then the last type of chart is called as the point and figure chart. Now, in case of point and figure chart, there's a third and the more complex type of chart. So technical analysis, it helps the technical analyst to predict not only reversal in price trends for common stocks, but to forecast future price movement. So it is more complex than a bar chart, and a point and figure chart has three following features. So let me show you the point and the figure chart so that you will get an idea basically. Okay, so it is more yeah, you can see here. Yeah. See, in case of point and figure chart, it is a more complex than a bar chart. Only significant price changes are recorded, while the vertical scale on a PFC represents the price of the stock. Okay, the horizontal scale does not represent the time scale in the usual sense. Each column on the horizontal scale of the PFC represents a significant reversal. Now let me explain you what is that cross over there. See, in case of point and figure is a charting technique used in technical analysis. So point and figure charting does not plot price against the time as time-based charts do. Instead, remember this, students, the important difference here. Instead, the point and the figure chart, it plots price against the changes in direction by plotting a column of X. You can see, watch my cursor here, X. So what does this X indicate? It indicates that it plots price against the changes in direction by plotting a column of X. As the price rises, see here, as the price rises, it is indicated by X, and a column of zeros as the price falls. Okay, so normally they use X or cross mark and zeros. When the price appreciate, they use X, and when the price falls, it is O or zero. Now, what are the advantages of this point and figure chart? They're based primarily on price action, not on the time. So if there are no significant price movements over time, the point and the figure chart will show no new data. So how to draw this point and figure chart, students? The correct way to draw a point and figure chart is to plot every price change, but practicality has rendered this difficult to do for a large quantity of stocks. So many point and figure chartists use the summary prices at the end of each day. So some prefer to use the day's closing price, and some prefer to use the day's high or low, depending on the direction of the last column. The charts are constructed by deciding on the value represented by each X and O, that is 0. Any price change below this value is ignored. So point and figure act as a sieve to filter out the smaller price change. The charts change column when the price change direction by the value of a certain number of X or O's. So this was about the point and figure chart. So what I will stop the session here, and just do a revision of that. I'll be sending a couple of other videos so that you can understand this charting in a better way. So any doubts still here, students? And tomorrow also I'm scheduling a session, arranging a session on technical analysis especially, so that majorly, if you have more and more sessions, then at least you will understand how to predict the price movement when it comes to technical charting. So probably by this week, one more session I'll be arranging related to technical analysis, that is predicting the price movement of a particular equity stock using the Japanese candlestick, so that you will be in a position to at least understand what is the support level, what is the resistance level, when to hold. In the next class also, I'll be explaining you the upward trend, how to draw a trend line. That is very important, students. When it comes to the equity share, you need to first identify the trends, whether it is an upward trend or whether it is a downward trend or whether it is sideways. So in my next class, I'll be taking you to that also. Okay. So today I will end the class here. In tomorrow's class, I'll be explaining you the trends. Meanwhile, I'll be sharing a couple of other videos also to you, so that in a simple way also you can understand the charting. Okay, so thank you so much for your patience listening, students. Have a great day.